On a trading screen, nothing looks unusual. Treasury yields update in real time. Repo rates print normally. Clearinghouses process margin calls. Central bank balance sheets publish on schedule. Bond auctions still settle. Foreign exchange pairs still fluctuate. Interbank payments still clear through settlement systems. The infrastructure is operating. Yet in the background, several temporary measures remain in place. Liquidity facilities introduced during stress are still available. Capital buffers adjusted during volatility are still calibrated lower. Margin frameworks modified during instability have not fully reverted. No emergency is declared, but the temporary adjustments have not been removed. These adjustments are not abstract. They pass through formal channels. Central bank statements outline facility terms. Regulatory filings disclose revised capital treatment. Clearinghouses update margin schedules. Supervisory letters recalibrate liquidity expectations. The systems remain operational. Trading desks continue to transact. Risk dashboards continue to update. Settlement systems continue to reconcile positions. The adjustment is embedded inside functioning infrastructure. At first, that embedding feels temporary. Initially, the temporary measure carries urgency. Liquidity operations may expand in size. Repo facilities may increase in allotment volume. Standing swap lines between central banks may activate. Supplementary leverage ratios may be recalibrated. Risk managers treat these as transitional conditions. Internal stress models are updated. Liquidity coverage ratios are recalculated. Value at risk thresholds are monitored closely. Treasury desks adjust funding ladders. The assumption is that once volatility subsides, the measure will be withdrawn. But withdrawal requires stability that is clearly defined, and clarity is rarely immediate. If markets continue to clear trades, if settlement cycles complete on time, if interbank lending persists, if corporate bond issuance resumes, then the measure does not obstruct activity. And if it does not obstruct activity, its removal becomes optional rather than urgent. Consider central bank balance sheets. A facility introduced to stabilize short-term funding markets remains listed as an available instrument. The line item remains visible. The facility remains operational. Usage may decline. Availability remains. Banks incorporate this availability into their liquidity planning. Treasury departments model short-term funding assuming access to standing facilities. Money market funds evaluate collateral eligibility within the adjusted framework. Primary dealers incorporate repo capacity into inventory management. The measure remains labeled temporary. Its presence becomes embedded. In derivatives markets, margin adjustments follow a similar pattern. An exchange increases initial margin requirements during elevated volatility. Clearing members post additional cash or high-quality government bonds. Risk engines recalibrate exposure metrics. If volatility stabilizes but does not collapse, the elevated margin remains. Traders adapt position sizing. Hedge funds rebalance leverage. Prime brokers adjust financing terms. The higher margin level persists long enough to become routine. No new announcement is required. The clearing system simply operates under the revised calibration. Funding markets reflect gradual normalization around extended measures. Repo operations roll forward daily. Commercial paper markets adjust maturities. Certificates of deposit reprice incrementally. Bank term funding programs remain accessible. Each extension is technical. Each renewal appears procedural. Balance sheets absorb the change. Regulatory flexibility often evolves the same way. Capital buffers may be allowed to operate closer to minimum thresholds. Countercyclical capital requirements may remain adjusted. Liquidity stress scenarios may be recalibrated to reflect prevailing funding conditions. Supervisory letters reflect these calibrations. Regulatory reporting templates remain unchanged. The ratios are still calculated. The buffers are still cited. What changes is the tolerance band within which variation is accepted. Participants respond mechanically. Risk committees meet as scheduled. Compliance departments file reports on time. Audit teams verify exposure levels. Investment committees review allocation models. The environment feels adjusted but not unstable. Trading screens continue to display benchmark rates, SOFR, Euribor, and Treasury yields. Bond auctions clear. Equity markets open and close. Foreign exchange pairs fluctuate within established corridors. No part of the infrastructure halts. Temporary measures become integrated through repetition. A swap line extension between central banks is renewed. A standing repo facility remains open. A liquidity support program is rolled forward another quarter. The headline fades. The operational reality persists. Treasury teams plan funding windows assuming continuity. Portfolio managers price risk relative to adjusted financing costs. Asset liability committees monitor duration gaps under the extended framework. Planning replaces speculation. In corporate credit markets, this integration becomes visible in issuance behavior. Companies refinance maturing debt under prevailing funding facilities. Investment-grade spreads stabilize around adjusted baselines. High-yield issuance reopens cautiously but consistently. The temporary support structure remains in the background. Underwriters model demand under the revised environment. Syndicated loan desks incorporate updated covenants. No one announces that the temporary condition has become durable. They simply operate as if it will remain available. This does not eliminate constraint. Collateral must still be posted. Capital ratios must still be reported, liquidity metrics must still be met, risk limits remain in place, but the presence of extended measures reduces the urgency to resolve underlying imbalances immediately. Resolution is replaced with management. Management is easier to sustain than reversal. Over time, the distinction between emergency tool and standing facility becomes less operationally relevant. The policy statement may still refer to temporary measures. Review dates may still be scheduled. Minutes may still describe the facility as conditional. Yet internal dashboards reflect continuity. Treasury cash flow projections include extended liquidity lines. Funding strategies assume rolling access to repo windows. Clearing members plan collateral movements under stable margin frameworks. The system functions within the measure. In this phase, nothing signals culmination. Central bank statements continue to reference evolving data. Regulatory agencies publish routine updates. Exchange rulebooks remain in force. Temporary does not become permanent through declaration. It becomes structural through repetition. The key shift is administrative. Instead of asking when the measure will end, institutions focus on how to operate efficiently while it remains. Asset allocation models incorporate adjusted risk-free rates. Corporate treasurers lock in funding at revised term structures. Banks manage net interest margins under sustained facility access. The measure supports continuation without demanding attention. Continuation lowers friction. Lower friction sustains liquidity. Sustained liquidity reduces visible stress. Reduced stress removes pressure for withdrawal. The cycle reinforces itself quietly. No formal transition is required. Temporary measures, extended long enough, reshape expectations. Risk appetite recalibrates to reflect available support. Volatility bands narrow within adjusted ranges. Credit default swap spreads stabilize relative to the new baseline. None of this requires a declaration of permanence. It requires only consistent application. Eventually, the measure's origin becomes secondary. Participants no longer reference the initial volatility spike or funding dislocation that prompted it. They reference current conditions, current repo rates, current treasury yields, current credit spreads, current liquidity metrics. The infrastructure remains active. Nothing collapses. Nothing resolves decisively. The facility remains available. The buffer remains adjusted. The reporting flexibility remains in place. Temporary language continues to appear in documentation. Operational behavior treats the measure as part of the landscape. In financial systems, infrastructure does not need to announce itself. It only needs to function. Settlement systems clear trades. Clearinghouses process margin calls. Central banks publish balance sheets. Regulators issue periodic reviews. Activity continues. When temporary measures stop being temporary, there is no formal turning point. There is only extension. Extension after extension. Review after review. Application without withdrawal. The system does not redefine its architecture. It continues using the tools already in place. And over time, those tools cease to feel provisional. They become ordinary, handled within risk dashboards, reflected in capital planning, embedded in funding models, without urgency, without escalation, without requiring anything further to occur. The environment continues, and the measure remains.